Now today we are going to discuss about the most important, yes, the most important topic. That topic which really students are confused about. That topic which has amendments this time. That topic which we need to understand for our lifetime. Such topic we are going to understand. So listen to the video till the end. One advantage shall I tell you? We'll have numerical problems also to practice to understand the topic in more depth. Amendment, so I feel exam wise this is important. And lifetime we have to live with this topic. So very important, don't skip, completely listen. Okay, right. So the topic's name is, yes, topic's name is Provident Fund. What is Provident Fund? I'll tell you very simple stories like a common man will try to understand, and understand as if you are a layman. Don't try to understand as a I'm a professional student. Or leave it for some time. Okay, you will understand as a layman and you will be able to prepare for exam, write the exams as a professional. That's what we'll try to balance today. Are you ready? Yeah. So let's start. First thing, suppose you are working in a company and one day you got an idea that, sir, I am working, I am getting salary, but suppose if I retire, I'll not get salary, right? Who will take care of me? How will I survive? How will I get money after retirement? All these questions really bothered you and you were really crying. So when you are crying, you are really frustrated. Your employer came to you, asked him that, hey employer, please give me salary even after retirement, even after 60 years. Employer said, no, how can I? Is it possible? No. So your stress again increased. Then you went to government. You asked government, can you do something for me? Government said, no problem, bacha, for you we will do something. And government introduced a provident fund scheme where what will happen? Your employer, whether it is government employer or private employer, has to contribute some percentage of your salary from his pocket, not deducting from your salary. Okay, and also deduct something from your salary, same percentage from your salary, and that two amounts they will accumulate and deposit with a government authority or a separate fund, and that fund will again invest into some debentures, securities. It will earn some interest income, dividend income, and the money will grow. Sir, will I get the money? Wait, you will not get the money till retirement. So only on retirement you will get the money. This way what happened, that your retirement life is protected, and that wonderful concept which really helps you to take care of yourself financially after retirement is called as the provident fund. Okay, so here who contributes? Employer contributes. Who else? You yourself, the employee also contribute, and all that money is deposited in a fund which will again reinvest the money and earn more and more money, so that you get more money at the time of retirement. It will not be given as lump sum, it may be given as lump sum, depends upon different types of provident funds. Okay, yes sir, understood. Now in this provident fund, employer contributed, I said, on that interest income will be there, that also I said. Again employee contributes, again on that interest income. So these are the four components at the end you will be getting. Okay, but there are how many types of provident funds in India, do you know? There are four types of provident fund. How many? Four. First one is statutory provident fund, second one is public provident fund, third one is recognized provident fund, fourth one is unrecognized provident fund. What is this statutory provident fund? This is a fund created by the government for the government employees. So if you are working in the Ministry of Finance, you are working in the Railway Department, so government organizations, you will be covered by the statutory provident fund. Here also same contributions by employer, that is government, by you, that is employee, and interest will be there. All that will happen. Now in which year it was set up, all that is irrelevant for tax purpose for the time. Okay. Now second thing, there are some people like me also. We don't work in any college, we don't work in any institution. We are either self-employed or unemployed, whatever you say, no problem, right? So we are self-employed basically. Now where will we contribute? How can we protect our life after retirement? For that, they introduced a concept called as public provident fund. What they said? Public provident fund. So here I can open an account in any bank in the name of provident fund, that is public provident fund, and can also save the money. That will multiply, government will give interest on the money invested, and retirement can be protected with that. How much we contribute, on that basis we will get the return also. Okay. But the third one, which is not by for self-employed people, not for government employees, but for non-government employees, it is called as recognized provident fund. Basically, if you are employed in a non-government organization, you will be covered by the recognized provident fund mostly. Actually, we use the word recognized because it is recognized by the CBDT, Central Board of Direct Taxes, right? This has certain set of rules. If the fund approves, follows that rules, CBDT will call it as recognized provident fund. And if suppose the fund is not registered with the CBDT, then we will call it as unrecognized provident fund. Simple or difficult? Very easy, right? Yeah. Shall I take things forward? Now, how the tax treatment should be? Well, now you understood that there are four types of fund. First one is statutory provident fund. Second one is public provident fund. Third one is recognized provident fund. Fourth one is unrecognized provident fund. So, like this we try to understand. But how the tax treatment should be? Shall we discuss? Are you all ready? Now, I have two ways in which I can actually discuss about it. So, shall we take fund wise? That would be better. Okay. So, each fund, all components we will discuss at a time. Are you all interested? That would be great, right? Yeah. So, let's start. So, basically I already said that every fund will have how many components? Can you tell me again? 4 components, sir. Statutory no. Statutory provident fund will have 4 components. Here the employer's contribution, employee's contribution, interest on employer's contribution, interest on employee contribution, and last one is when we withdrawal. So let's consider 5 parts. Interest I will discuss together. Are you okay? Now let me tell you employer's contribution, what will happen. So it is government statutory provident fund, correct? So employer's contribution is fully exempt. Employee's contribution, government has to encourage, correct? So what government said? Okay, we will give deduction under ATC. So under ATC deductions, so to save some tax, government said if employee contributes, you will not only earn income, but you will save tax today, that is this assessment here. So for that ATC deduction. Interest is also fully exempt, whether it is employer's contribution related interest or employee's contribution related interest, both are fully exempt. And the withdrawal, that is also fully exempt. So ये तो पूरा exempt, employee contribution पे deduction under ATC. You understood it right. In English what we say? You nailed it right. This type of language we should improve. English communication is very important. Chalo, what I was talking about, statutory provident fund. Employer's contribution, now I want you to answer. Exempt. Employee's contribution, deduction under ATC. Interest on employer's contribution, exempt. Interest on employee contribution, exempt. Withdrawal, exempt. So at the time of retirement, when you get the money also, that is also fully exempt, not taxable. Clear? Shall I go to public provident fund now? Now why I am talking about public provident fund now? Because under section 10 subsection 11, correct, section 10 subsection 11, statutory provident fund and public provident fund both are covered. Section 10 subsection 11, statutory provident fund, public provident fund, both are covered. Okay, shall I start? Yeah. Here you tell me, it is public provident fund. Will there be any employer? अरे यार पब्लिक प्रोविडेंट फंड भूल गए, यू फॉरगॉट. अरे बेरोजगार मेरे जैसे लोग, सेल्फ एम्प्लॉयड पीपल, राइट? राइट. So for such people, so there is no employer, so no talking about employer's contribution. Self contribution, you will get deduction under 80C. Self contribution, you will get deduction under 80C. Clear? Interest on the contribution, exempt. Withdrawal, exempt. Clear? Clear? Yeah. So obviously 5 elements should be there. Like employer's contribution, no, not applicable. Interest on employer contribution, not applicable. Employee's contribution, 80C deduction. Interest on employee's contribution, exempt. Withdrawal also exempt. So PPF and SPF are same. That's why both are covered under section 10 subsection 11. Okay, okay sir. Now coming to the recognized provident fund. Are you ready? So here there is a little more deep dive we have to do, because some litigations, ifs, buts are there. Yeah. So are you ready? Yeah. Chalo shuru karte. Employer's contribution. What I said, employer's contribution. Up to 12% of salary exempt. Right? That means beyond 12% taxable. Okay. That means suppose your salary is 50,000 rupees and employer said into 12%, so 6,000 is there. That 6,000 is exempt. If employer contributes 15%, then what will happen? 50,000 salary into 15%, so it will come to 7,500. So that extra is there, na, 1,500. That will be taxable. Okay? Yes. Suppose example, Mukesh Ambani, being the richest man in India, don't draw the highest salary in India, if you know or don't know. But still he draws 1 crore per month salary. Now all these are rumors, we actually don't know exactly what he gets. But suppose he takes 1 crore per month salary, so for him how much provident fund will be there? 12 lakhs rupees exempt. Wow, so much, right? 12 lakhs income not taxable. Happy, right? Mukesh Ambani is super happy. So anyhow, if suppose Reliance contributes suppose 14%, then that extra 2 lakhs, that is 1 crore into 14% is 14 lakhs, and up to 12 lakhs, that is 12% of 1 crore is exempt. So that extra 2 lakhs is taxable. Clear to all of you? This is what employer's contribution, up to 12% exempt, beyond the 12% taxable. Now employee's contribution under 80C deduction is given. So if you are contributing or Mukesh Ambani is contributing, they will get deduction under 80C. So if you as an employee contribute to the recognized provident fund, deduction under 80C is given. Okay, are you clear? Yes sir. Now come to the next story. interest on the contribution. Whether it is employer or employee, same rule. So that's why we'll discuss. Up to 9.5% of the interest is exempt. How much? Up to 9.5% of salary. Sorry, up to 9.5% of the interest on the contribution, accumulated balance of the contribution on that 9.5% interest is exempt. Beyond that, it is taxable. Okay. So, interest is not on salary, interest is on the contribution. Okay. So, that is basically taxable if it is more than 9.5%. Now, many years back, in 1970s, 1990s, like that, government was to give even 16%, 14% interest. That's why beyond 9.5% was taxable at that time. From last many years, the interest is just 8%, 7.9%, like that. So that means now presently, practically, I am telling, is it taxable in today's world, or is any interest taxable? The answer is no, it is not at all taxable, because they are not giving an interest which is beyond 9.5%. So that's why interest is not taxable in present times. For your exam, they may give that interest on the contribution is 12%. In that case, you will say up to 9.5% is exempt. Beyond that, 2.5% is taxable. From exam perspective, it's okay, but practically, presently, government is not giving that interest. It is way less than 9.5, presently around 8%. Okay. थोड़ा सा practical भी knowledge रहना ना. You cannot say that sir textbook only. Today's world has become more practical, right? Let us try to connect it to it. Shall we go to the next? Sir, what about the withdrawal? We'll discuss later on. Are you okay with it? Right? Chal. So what I said till now, I spoke about the recognized provident fund. If you have heard right, recognized provident fund. Employer's contribution up to 12% exempt. 12% of salary exempt. Beyond 12% taxable. Employee's contribution deduction under 80C. Okay. Then interest up to 9.5% of the contribution or accumulated contribution exempt. Beyond that taxable. Withdrawal we'll study later on. Okay for all of you. So RPF withdrawal I held it for some time. Okay. Yes sir. Shall we go to unrecognized provident fund? Here government don't recognize it, right? So when government don't recognize, why should they tax? So they say employer contribution ignore, employee contribution ignore, interest on employer-employee contribution ignore. Sir, this unrecognized provident fund is very good, right? Wait. Now I'll tell you the real fact. When the whole amount is withdrawn from unrecognized provident fund or from unrecognized to it becomes recognized provident fund. So unrecognized provident fund is converted to recognized provident. Any of the two happens. Whether the whole amount is withdrawn by the employee or unrecognized provident fund becomes provident fund, normal recognized provident fund. In this case, what will happen with the withdrawn money? What will happen with the money in the fund which is transferred to RPF or which is withdrawn by the employee? So again we have to see the four components. Employer's contribution and second component interest on employer's contribution. Both are taxable under the head salary. Entire amount, no exemption, no 80C deduction. So unrecognized provident fund, when it is withdrawn, employer's contribution, interest on employer's contribution, both are taxable under the head salaries. Third component, employee's contribution. Ignore. Why? Because array his own amount, right? That's why we will not consider. And we have to understand this. It is already taxed, right? Not even ATC deduction is given. So that's why employee's contribution is ignored under your PF. When withdrawn, it is ignored. But interest on employee's contribution taxable under income from other sources. In the exam, they will ask you in case of unrecognized provident fund at the time of withdrawal, interest on employees' contribution is taxed under the head A. Salaries, B. Other sources. What will you tell? If you say salary, then you are making a fool of yourself. Remember, interest on employees' contribution under your PF at the time of withdrawal is fully taxable under other sources. Clear? Yeah. Now, URPF you understood. But what about RPF withdrawal? If recognized provident fund is there, like it is recognized by the income tax department, or it is a fund as per the Employees Provident Fund and Miscellaneous Provisions Act 1952, if it is the case, then what the treatment should be? When it is a case of withdrawal, they ask a question. When did you withdraw? When you are withdrawing? Sir, after 5 years of service, sir. Then government says, no problem, not at all taxable. So if you have contributed for continuous 5 years and after that you are withdrawing, then it is fully exempt. After that, if you are withdrawing, then it is fully exempt. If you are withdrawing after 5 years, it is fully exempt. But sometimes you may withdraw within 5 years also, right? The period of contribution may not reach 5 years, but in the second year, third year itself you withdraw. Then what to do? Then government said, are you withdrawing because of your ill health medical treatment? Yes, sir, fully exempt. Are you withdrawing because of your employer's business closed? Yes, sir. Oh, it is fully exempt. Are you withdrawing because you are planning to transfer these funds to new pension scheme? Yes, sir. Then no problem. Exempt. Are you withdrawing because you are transferring this provident fund to the new employer where the new employer also have the provident fund? Yes, sir. Then exempt. Are you withdrawing because the reason because of your withdrawal is beyond your controls? Yes, sir. Then also exempt. Are you withdrawing because of any reason which is other than the above list? Yes, sir. Then fully taxable. Are you able to understand what I said? Right? Shall I repeat? Chalo. I am talking about what? I am talking about the recognized provident fund. क्या बोला मेरे बेटो? दो ध्यान से सुनो. Recognized provident fund. And what they said about recognized provident fund? Please tell me that withdrawal after 5 years. Chalo. I'll try to sing like a song and you try to give the answer. Of course, I will also give. Okay. Withdrawal after 5 years, fully exempt. Right? Withdrawal within 5 years because of ill health, fully exempt. Withdrawal within 5 years because of the employer's business closed, so fully exempt. Withdrawal within 5 years because transferred to NPS, fully exempt. Withdrawal within 5 years because you are transferring or your job is shifted to new employer and your fund is transferred to new employer's provident fund, fully exempt. Are you withdrawing because of the reasons beyond your control? Fully exempt. In all other cases, fully taxable. But how it is taxable? Same like URPF. What I said? Same like URPF. That means employer's contribution and interest on employer's contribution taxed under salary, is it? Yes. Employees contribution is ignored? Yes. Interest on employees contribution taxed under other sources? Absolutely yes. Sir, we understood completely. I know you will, because you are super intelligent. What happened actually is, from our childhood, we heard from teachers. What we heard? Hey idiot! Always teachers will say, hey idiot! And continuously when you hear the same dialogue, your brain actually tries to accept the fact that you are idiot. So this practice is totally wrong. Even though student did not understand, never ever scold him by saying that you are idiot. And you can scold him in a very positive way. Hey, you are such an intelligent student, how you did not do this? I believed that you will do it. You are busy with playing. Arey, you could have completed it and then played. What's the problem? This is the positive way of scolding. If you get the opportunity to scold anybody, do follow the practice which I said. So not the earlier one, please. Huh? Right. So we understood what? That you are intelligent. Hey, there is one God who says tathastu. So, right? So that's why always tell positive. चलो आगे बढ़ते हैं यार, थोड़ा सा मैं डिस्टर्ब किया आपको. Now, what about the NPS? There is one more concept which we have to discuss is about new pension scheme. Suppose if the employer contributes to the new pension scheme, it is taxable under the head salary. If the employer contributes under new pension scheme, it is taxable under salary chapter. अरे सर फिर फायदा क्या है? Don't worry Baba, you will get deduction under 80 CCD. Sir, what is 80 CCD? If I tell everything in this section, this only, then how will you understand when I discuss deductions? So in deductions video, you will understand. Okay. As of now, simply remember new pension scheme. Whatever contribution taxable under employer's contribution, taxable under salary chapter. But then for the same, you will get deduction under 80 CCD. Clear? Sir, understood. Now, there are some amendments, some new changes which the government tried to bring. And really we have to understand that, and I tried to give some hints also before. Shall we start? चलो, ये कहानी है पुरानी. I am talking about the Finance Act 2020. So, first I'll talk what are the changes which Finance Act 2020 brought, and then ये कहानी है नवी. नहीं, अरे गाना नहीं आया, चलो कोई बात नहीं. So new also in Finance Act 2021 some changes are there, that also I will discuss. So ये कहानी है पुरानी, let us discuss that first. So what happened? Government through the Finance Act 2020, what they did? They said that contribution to employer's provident fund, sorry, recognized provident fund, up to 12% is exempt. Now suppose your salary is 50,000 rupees. So up to 12%, 6,000, गरीब आदमी है, जाने दो बेचारे को exemption दे दो, ठीक है? Like that exemption can be given, and it's right, government should support the middle class and the poor. But then think about Mukesh Ambani, 1 crore salary, right? Again into 12%. So 12 lakhs exempt. Now do you feel that employer's contribution which the employee is earning income, and that to 12 lakhs rupees, should the government exempt such a huge amount? Right? Benefit of exemption is to protect the poor people, middle class people. But rich people are there. How can you really give so much of big exemptions? Right? And moreover, Narendra Modi always say, अमीरों से लूंगा और गरीबों को दूंगा. So when he said he has to do it, right? So he introduced a provision. I'll tell you, don't worry the provision. Yeah. So what they said in the provision, that any contribution to provident fund or new pension scheme under 80CCD or the approved superannuation fund. I said three things. Okay. Because if government would have said only one thing, they would have shifted everything to the other. That's why government said we will not give any opportunity. All covered. Okay. So first one is, bolo to, provident fund. Second one, superannuation fund. Third one, new pension scheme under 80CC. If the contribution to all these three funds together in a year, I am telling very clearly, you have to understand. The contribution to all these three funds together, what are the three funds? Provident fund, superannuation fund and NPS, new pension scheme under 80CCT together by the employer. So who is contributing? I am only talking about employer. Okay. Employer's contribution to provident fund, new pension scheme under 80CCD or superannuation fund together accumulated in a particular financial year, that is from 1st April to next year's 31st March, exceeds rupees 7,50,000. What I said? Exceeds rupees how much? 7,50,000 rupees in a year. 7,50,000 rupees. Then up to 7,50,000 exemption can be given. Yes, exempted. But beyond that, it would be taxable. Beyond that, the contribution will be taxable. Beyond that, the contribution will be taxable. Suppose I will take the Mukesh Ambani's example. Why I started at the start of the class, you now able to remember, right? Why I tried to connect to you? Yeah. So 1 crore salary into 12%, 12 lakhs rupees. So what the government will say to Mukesh Ambani Saheb? Saheb, 7 lakh 50 ka exemption le lo Saheb. Now from 12 lakhs minus 7 lakh 50,000, that is Saheb, 4 lakh 50,000 is taxable portion. This is what the government said. Are you able to understand? You may feel that Mukesh Ambani may be drawing the highest salary. It's not the case. There are some other people who are getting even 5 crores rupees per month salary. Yes? You can search in YouTube, you will get so many people. Chalo. Then why you took Mukesh Ambani example? अरे it is easy to remember रे भाई. तुम लोगों को हर छोटी चीज पे डाउट आता है. Right? चलो. So what I basically tried to make you understand. I said that all that provisions till now are same. Nothing changed. But if employer's contribution to provident fund, new pension scheme under 80CCD or superannuation fund approved together exceeds 7,50,000, up to 7,50,000 is exempt, beyond that it is taxable. All the rich people in the country were very disappointed with this provision. Of course, their wonderful way of saving the taxes, huge amount of incomes they could have fully exempted, but bad luck, now they cannot. But when they read the second provision, they were even more frustrated. That is, the interest on this contribution, on this excess contribution, that also will be taxable. I'll tell you properly. Understand. So contribution up to 7,50,000 exempt, right? So interest on 7,50,000 also exempt. I said that extra in case of Mukesh Ambani 12 lakhs is provident fund contribution. So extra 4,50,000 taxable, I said. So interest on 4,50,000 also taxable. They were frustrated, they were angry. but there is no other chance. They have to survive with this. Correct? Now, if you say unfair, it is not unfair because they are earning huge amount of money from the country, one thing, and government gives lot of incentives, lot of subsidies in their industrial projects. So if government is giving some one way, government always have the right to take through some other routes also. That's how the economy runs. So if you feel that government is doing unfair treatment to Ambanis and the rich people, it is totally wrong. Now sir, how to calculate this? Now the calculation also has to be done. How to calculate the interest, taxable portion of the interest on excess contribution. So CBDT came up with a circular. Now the formula when you see, so complicated now, I took nearly 4 hours to understand. But you will understand in 15 minutes because you are sitting with me. TP తిని వండుకోవడం గురించి మాట్లాడతలేరు నాయన. TP is taxable perquisite. Okay, right. So here TP means taxable perquisite is equal to PC by 2. Array PC means principal contribution by employer. Okay, by 2 into R. R is nothing but return. So what is the interest they are earning? We can say return. Okay, PC by 2 into R. TP is equal to PC by 2 into R. Okay. Now, when government introduced these provisions, government cannot be unfair with these people, correct? So government said, okay, whatever contributions made till, because this was brought in Finance Act 2020, right? Till 31st March 2020. So whatever contribution made till 31st March 2020, that is exempt. And interest on that contribution also exempt. Okay, whatever contributions they made till 2020 31st March, and interest on that is totally exempt, because government brought the law, and when they bring the law, after that they should tax people. Government cannot say that we will go back and tax all your incomes in the past. It would be unfair, right? And this government is really fair in treating the people. So that's why they said all the previous contributions and the interest is exempt, right? Which contributions are made till 31st March 2020. Even after 31st March 2020, contributions up to 7,50,000 are exempt, and interest on that 7,50,000 also exempt. So government is giving good amount of opportunity for it. But if it is beyond that, government said we will tax it. So that means, if suppose in 2020-21, Mukesh Ambani's extra salary, that is 4,50,000 contribution is there, on that interest is there, it is taxable in that year. But wait, that 4,50,000 plus the interest will be considered in this year 21-22. On that, again, whatever interest comes, that will also be taxable. That means whatever taxable portion of your contribution is there, on that every year whatever you get interest, that is taxable. Now how will we know that? For that government brought this formula. So TP is equal to taxable perquisite, or in my simple language, taxable interest or dividend income, okay, for the current year, is equal to PC by 2 into R. What is PC? PC is nothing but your current interest dividend income divided by 2 into R, that is return, plus, now last year also some taxable portions may be there, right? taxable principal contribution may be there. That is denoted as PC1. And last year also some taxable interest portion may be there, right? That is TP1, TP1, TP1. Okay. And again into R. This year how much interest? So this way, what they did, they created the formula. So TP is equal to PC by 2 into R for current year plus PC1 plus TP1 into R for last year interest. Oh, last year principal, taxable principal, last year interest, taxable interest. On that, what is the current year interest? That is denoted by PC1 plus TP1 into R. Are you clear? Exempt is ignored. Whatever exempt till 31st March 2020, whatever contribution is there, whatever contribution made till that period, on that whatever interest is there, government said we will not touch on it. We will not tax it. Government is fair. And current year, every year also up to 7,50,000 and interest on it we will not touch. But beyond that, whatever taxable portion, beyond that, whatever taxable interest portion, that will be taxable and that will be accumulated every year on that accumulated balance. If you get interest, that is taxable. And that is denoted by PC1 plus TP1 into R. So now you are very clear with the formulas. TP, taxable interest dividend for the current year, is equal to PC, current year contribution, taxable contribution, by 2 into R, that is return interest, okay, plus PC1, that is accumulated taxable contribution by the employer, that too accumulated I said. So it includes so many years except the current year. Whatever previous years are there, all are included, but this starts from 1st April 2020, okay. And plus TP1 is also same, all past years interest taxed accumulated, but it started only from 1st April 2020 into R. This is how the formula is. Are you clear? This is how you should compute. Hey, we'll do some problem to make you understand. But this became more worst for the rich people when government introduced the Finance Act 2021. What the government said. Now, till now, what I was talking about the employees' contribution or I was talking about employers' contribution? Sir, till now you only spoke about employers' contribution to Provident Fund, Superannuation Fund and new pension scheme under 80CCD. On that, if it exceeds 7,50,000, the contribution is taxable, interest is taxable. That we discussed only about employers till now. But the rich people self also they will contribute, right? If suppose government don't make the rule for employees contribution, then they would have said, okay, we will not take any contribution from employer. We will contribute everything from our salary. And they will enjoy the exemptions. This should not happen. That's why government said, no problem, from 1st April 2021, on the employee's contribution. Hey, if employee contribute for his retirement benefit, his hard earned money, it should not be taxed. Government said, it's fair, employee's contribution, we will not tax. But the interest on employees' contribution is income, right? So that we will tax. This was the government's version. So government said that also we are not cruel. Government said up to 2,50,000 contribution by the employee. On that any interest we will not tax. But if the contribution exceeds 2,50,000, that means employees contribution exceeds 2,50,000. On that whatever interest is there, that we will tax. Clear to all of you? Yes or no? So 7 lakh 50 when I talk, it is employer, Malik. Okay. If Reliance Industries is there, Reliance Industries contributing, we will check 7 lakh 50. If Mukesh Ambani individually contributes 2 lakh 50, we will check. So if contribution by employee, any contribution, it is fully exempt, no taxing. But interest on employees contribution, that too up to 2 lakh 50 contribution, whatever interest, no taxable. But contribution more than 2 lakh 50,000, on that interest portion is taxable. Are you able to understand? It's not complicated now, correct? Are you understanding? Government said no problem. How to calculate? We'll make a simple system. Okay, don't worry. Whatever employee contributed till 31st March 2021 and the interest on such contributions till date and in future also, all that let us keep it in the same fund. Okay, and employee contribution every year further, let us keep add in the same fund till 2,50,000. Okay, yes sir. But if employee contributes more than 2,50,000 in the current years, add it to the new account or new sub account. Create a new account and transfer that excess employees contribution beyond 2,50,000 to that account, and whatever that account earns that extra interest, that let us tax. If that excess contribution accumulate, next year again we get extra interest, that is tax. This way government made a simple system for taxing it. But then there are some self-employed people like me or unemployed people like me. We will say, sir, it is unfair, sir, because employer is there. So for employer also you gave some exemption. So there also job holders are getting benefit, and self contribution also they are getting benefit. But people like us, self-employed people, we contribute to provident fund. For us also you give only 2,50,000 till contribution exempt. That is unfair, sir. Please consider people like us. Government said okay, this is also fair. Up to 5 lakhs rupees self contribution in the PPF will be fully exempt. That means contribution is anyhow exempt, but interest on that 5 lakhs is also exempt. Beyond that, any contribution that will be taxed. Okay. Now 5 lakhs when it will be there? If you are not, if your employer don't contribute and the employee only contributes, or you are only contributing as a self, then rather than taking 2,50,000, they took 5 lakhs. Contribution irrespective of the limit is fully exempt, but interest on contribution will be exempt up to 2,50,000 normally, up to 5 lakhs where only the employee contributes. Okay. So interest on contribution element we discussed. I feel all the provisions are clear to you. Shall we solve some problems really to build confidence? Are you ready? Now let's understand this provision. First regular provisions we will understand, then amended provisions also we will try to understand. Mr. X has the following salary structure. Now what they said, basic salary is given and that's 10,000 per month. DA is given, that is 1,000 rupees per month. X contributes rupees 20,000 to Provident Fund. Okay. X contributes 20,000 to Provident Fund. So employer also makes a matching contribution. So what they asked, compute gross salary of, if they said. But let's try to recheck what are the data given. I said basic pay is given 10,000, DA is given 1,000 per month, and they also gave some commission. It is fixed commission, okay? And then they said entertainment allowance. So fixed commission is there, entertainment allowance is there. They have basic pay, they have DA, and employee contributes 20,000. Employee also contributes 20,000. Now we have to calculate. What we have to calculate? They will tell. Let's see. Now during my explanation, if X is a government employee, then he will be subject to statutory provident fund, and such provident fund is a statutory provident fund. How the treatment should be? If X is an employee of Y Limited and such a fund is recognized provident fund, the things will be different. X is an employee of Z Limited and such fund is unrecognized provident fund. In these three cases, the entire treatment will differ. So that's why we have to do. But please understand that salary for the purpose of RPF we should remember. Basic pay plus DA retirement plus commission on turnover. Basic pay plus DA retirement plus commission on turnover. Let's start. So shall we solve? Because they asked to compute not only the taxable provident fund, but they asked us to compute the entire salary itself. So let's try to draw down the mains pro forma and then do the workings wherever required. Obviously it would be required. So answer, computation of taxable salary, computation of taxable salary of Mr. X for the assessment year 22-23. So everybody write down computation of taxable salary of Mr. X for the assessment year 22-23. Now we have three different situations, so we'll call it as cases. So let's write down particular case A, then case B, then case C. Because we have to do some workings, we'll write in case A details and amount. In case B also details and amount. Case C also details and amount. So that we'll have something to write there to solve the problems. So draw the pro forma properly, everybody. So particulars, case A, case B, everybody wrote. Now everybody should remember that basic salary is always taxable. So write down basic. It is 10,000 per month, right? So in a year it would be 1,20,000. So no doubt about it. So it would be same for all. So case A 1,20,000, case B 1,20,000, and case C again 1,20,000. So case A 1,20,000, case B 1,20,000, case C also 1,20,000. Now because we completed basic pay, we have commission also. Allowances we'll write later on. So write down commission, it is fixed, right? So as it is we'll write 2,000, 2,000, 2,000 in all the cases. 2,000, 2,000, 2,000. Now in the name of allowances we have only two things. So directly we'll write dearness allowance. It is 1,000 per month, right? So 12,000 we'll write in the column. Same way 12,000, 12,000 in all the three. Because there is change in the provident fund aspect in all the three cases. All others are same. So dearness allowance 12,000 in all cases. Entertainment allowance 24,000 because 2,000 into 12, right? Same way 24,000, 24,000 in all the cases, right? Now what is the total of allowances? We know it is 12 plus 24. So let's write down 36,000. Then in all the three cases, allowances total DA is 12,000, entertainment allowance is 24,000, so 36,000 will come. Now with this note, only one item left for treatment, that is provident fund. Now you all remember that employees contribution is not taxable, it is deductible under ATC. So only employer's contribution we should discuss. So write down employer's contribution to PF. Now in internal column we are writing, because we got 20,000, it is given in the question. In all the three cases we will write 20,000. Sir, you said here there is a change. The change is not in the contribution amount. Change is in the exemption amount. Okay? Right. So employer's contribution to provident fund 20,000 in case A, 20,000 in case B, 20,000 in case C. Less exempted. Less exempted. In statutory provident fund, entire amount is exempted. That's why we'll again write 20,000 in the exempted column and outer column nil. Right? Statutory provident fund, we discussed entire amount is exempt. Case B, because it is recognized provident fund, we need to calculate, we will do later on, okay, because workings are involved. In case C, it is unrecognized provident fund, right, and they ignore, they don't tax it when contributed, they will tax only at the time of withdrawal. So entire 20,000 is exempt. So in outer column we will write nil. I am talking about case C. 20,000 is the contribution, 20,000 is exempt. So nil, nothing taxable. Now only thing left in solving our problem is the recognized report. So let's write down so that we have to do proper workings. We'll write in the notes, that would be better. So write down note. First note, because statutory and unrecognized is exempt, that we should mention, right? So note 1, contribution to statutory and unrecognized provident fund. Contribution to statutory and unrecognized provident fund is fully exempted. Is fully exempted. So only RPF we are calculating, okay? Right. Contribution to recognized provident fund you all know, right? Up to 12% it is exempt, that only. Contribution to recognized provident fund is exempt, we'll write down, is exempt up to 12% of salary. Up to 12% of salary. So in a formula we will write, that would be easy for us to compute, right? Not draw any table. Base salary is equal to basic pay plus DA in terms plus DA in terms plus commission on turnover plus commission on turnover. Basic pay plus DA in terms plus commission on turnover is equal to, now you know basic pay is 1,20,000, right? Write down that 1,20,000 and you know DA is 12,000, right? You can see from the above question. Plus commission is there, fixed commission is there 2,000, but will not take because it should be on turnover to take it here. So we'll write nil. So 1,20,000 plus 12,000 plus nil is equal to 1,32,000. Is equal to 1,32,000. Okay, seriously we completed it. Now exempted RPF is, one line will write, exempted RPF is 1,32,000 into 12%. 1,32,000 into 12%. It will come to 15,840. It will come to 15,840. Clear? Yeah. This only will take in the main problem. Write down everybody, go to the main problem. Yeah, there you write. In the case B, employer's contribution, we wrote 20,000 in inner column. Here exempted we should reduce, right? So write down 15,840 there in the exempted part. That should be reduced, correct? Yeah. So when contribution is 20,000, exempted is 15,840. So what is the taxable portion? We have to write in the outer column. 4,160 will come. 4,160 will come. $4,160 will come. Okay. So we completed all the cases. Just we have to do the totaling. So write down last thing, gross salary. Last thing, everybody write down gross salary. And you know, in case a basic pay is 1,20,000, DA is commission is 2,000, DA is 36,000. So 1,58,000 should come, I feel. So gross salary case A 1,58,000. Everybody write down. Case B, it will be similar like case A, but extra 4,160 is there. So it will be added to that. So it will come to 1,62,160. 1,62,160. Case B 1,62,160. And write down case C. Case C will have same like case A, so 1,58,000. Nothing extra items are there. So 1,58,000 will come. With this note, you are able to understand these provisions. That's great. Now, this second question is relating to the exemption, that 7,50,000 interest, all that is there, na, employer's contribution. Relating to that, we are going to solve one problem so that you will know how the things are, what the intricacies are. Right? When I explained, I tried to practically explain many things to you. But till we put it in numbers, we will not. So let's start. What they said is, Mr. X is appointed as the CFO of ABC Limited in Mumbai from 1st May 2020. His basic salary is 5 lakhs 50,000 per month. Wow, that's wonderful salary, right? He is paid 10% as DA. 5 lakh 50 into 10%, 55,000 DA he is paid. He contributes 11% of his pay. That means basic pay plus salary only, na? 5 lakh 50 plus 55. So 6 lakhs 5 into 11% he is contributing, right? And they said 11% of his pay and DA. So they also specifically said towards his recognized provident fund, and the company contributes the same amount. So here company also contributes 11%, he also. So basically it is less than 12%. So as per the normal rules it is fully exempt, correct? But the accumulated balance in the recognized provident fund as on 1st April 2021 and on 31st March 2022 is 15 lakhs 35,000 and 33 lakhs 55,000. Now we have to know the average accumulated balance, correct? So for that we use one word called as FAVG. These two numbers will be useful there. Moreover, how much we earned the income this year, to know that also this will be useful. Okay, we'll do one after the other, don't worry. So early I'll not tell you everything respectively. Compute the perquisite value chargeable in the hands of X under section 17 subsection 2 clause 7 and 17 subsection 2 clause 7a. Basically 7 is about the contribution taxable. That means if you contribute more than 7 lakh 50, that extra will be taxable, right? That is covered under 17 subsection 2 clause 7. And the interest portion is taxable, we discussed it, right? That is taxable under section 17 subsection 2 clause 7a. We'll discuss both for the previous year 21-22. Let's go forward. Now first we'll do that 17 subsection 2 clause 7a. Write down. That is simple, right? Salary into percentage, we'll get some amount and then we'll do it. That's it. So write down perquisite taxable, perquisite value taxable under section 17 subsection 2, perquisite value taxable under section 17 subsection 2 clause 7 is equal to now we don't know what it is actually, right? But we only know that exempted is up to how much? 7 lakh 50. So first one we will write just 2 lines you skip and just write employer's contribution to PF. Write down everybody, just 2-3 lines you skip and write employer's contribution to PF. Write down 5,50,000 plus bracket open plus bracket open 10% of 5,50,000 here there is no commission, so we are not considering it. Now this is monthly, so all this we'll put it into bracket and we'll write 12 months into 11%. 11% is contributed, right? So what you got? 7 lakhs 98,600. When you do this, again I'll repeat for you. His basic salary is 5 lakh 50 per month. It is quite simple for you, yes or no? DA is 10% of 5 lakh 50. So it is 55,000. So 5 lakh 50 plus 55,000 will be 6 lakhs 5,000 into 12 months we will do. Whatever comes into 11% because in the question it is given. So when we do that, we get 7 lakhs 98,600. Okay. This is the contribution. Now you know that 7 lakh 50 is exempt. So what is taxable under section 17 subsection 2 clause 7? We have to write. So write down 7 lakh 98,600 minus, yeah, earlier we left something to write, na, that we will write. 7 lakhs 98,600 minus 7 lakh 50,000. 7 lakh 50,000 is equal to rupees 48,600 is equal to rupees 48,600. Okay. So this portion is clear to all of you or any doubt? No doubt? Correct? Shall we go to the next point? Yeah, right. Annual accretion on perquisite. Now we have to just calculate that 17 subsection 2 clause 7a, right? So that is annual accretion. So annual accretion on perquisite, annual accretion on perquisite, taxable under section 17 subsection 2, 17 subsection 2 clause 7a is equal to, you have to understand what is taxable for the current year, and that is PC divided by 2 into R, right? Plus PC1 plus TP1 into R. So everybody write down this formula. PC by 2 into R plus PC1 plus TP1 into R, correct? Now is equal to, we will write. Now what is the principal contribution taxable under for this year? This year we got 7,98,600 employer's contribution, 7,50,000 is exempt. So we understood that this year contribution up to 48,600 is taxable. So PC is 48,600. So write down 48,600 divided by 2. Divided by 2. Okay. But do we have other information to write? Do we know what is R, what is PC1, what is TP1? All that are not there, right? So we have to compute. Are you all ready? Let's start computing. So first and the foremost thing which we require is, we'll come to the little later, we'll leave some few spaces and write down. We have to first compute FAVG. What is the average contribution and accumulated balance we should compute? So write down FAVG is equal to balance to the credit of recognized provident fund balance to the credit of recognized provident fund as on 1st April 2021, as on 1st April 2021. That you know, right? 15 lakhs 35,000. That only we are talking about. Plus balance to the credit of recognized provident fund. We can use RPF word also. As on 31st March 2022. Divided by 2. Divided by 2 is equal to 15 lakhs 35,000 divided by 13 lakhs 55,000. Okay, 15 lakhs 35,000 plus 33 lakhs 55,000 divided by 2. 15 lakhs 35,000 plus 33 lakhs 55,000 divided by 2. So what is the average accretion? 24 lakhs 45,000. 24 lakhs 45,000. Right? This is average accretion. Now we need to compute the income. Now, we know that after 31st March 2022, the balance is 33 lakhs 55,000. But whatever contributed by the employer also we know, by the employee also we know, that we can reduce, and whatever in the past balance were there, that also we can reduce. So can we know the income for the current year? Dekho, today's total money is, suppose you have 100 rupees. You gave 30 rupees today, your employer gave 30 rupees today. In the past you gave 20 rupees each. So yeah, 20 rupees. So when we deduct what was contributed in the past, then what is the income earned, interest earned, will we be able to know, right? So what is the balance minus contributions will become the income. So that only we are going to write. Write down I is equal to RPF balance as on RPF balance as on 31st March 2022 minus 31st March 2022 minus employees and employers contribution, employees and employers contribution during the year, employees and employers contribution during the year minus RPM balance minus RPF balance as on 1st April 2021. As on 1st April 2021 is equal to 33 lakhs 55,000 minus, here we'll do the computation and then write the result. Okay, 33 lakhs 55,000 minus 7 lakh 98,600 minus 7 lakhs 98,600 minus 7 lakhs 98,600 again, because first one was employer contribution, second one is employee, that's why both the times equal contribution. So we reduced 7 lakh 98,600 two times. Okay, minus the earlier balance is also should be reduced, right? That 15 lakhs 35,000. 15 lakhs 35,000. Now is equal to what will you get? What is the accumulated income? right? That is 2,22,800. 2,22,800. 2,22,800. Okay. This is what the interest are during this year. Okay. Let's compute. Write down R. R is the return, right? Now I is your income and FAVG is your investment. So income by investment will be return. So that's why we'll write R is equal to I by FAVG. I by FAVG is equal to 2,22,800. 2,22,800. This is income. 2,22,800. This is income. Divided by 24,45,000. Divided by 24,45,000. How much is your return? 0.091. 0.091. So basically they are telling 9.1% interest you are earning. Okay, the answer is 0.091. Chal. Now I will ask you certain questions that we need to know the PC1. We need to know the TP1. But in the past, the contribution was very less. Reason being, he joined the company late, right? He joined on 1st May 2020. So he served only for 11 months. And when we see the accumulated balance does not reach above 7,50,000 in 2021 year. So that's why PC1 will be nil. And moreover, before that there was nothing, neither the provision nor the employment. So that's why there is no accumulated taxable contribution in the name of PC1. So if there is no taxable contribution, automatically means there is no taxable interest in the past, right? So let's write down super fast. PC1 is equal to nil. PC1 is equal to nil. PC1 is equal to nil. Next one you also write TP1 is equal to nil. Reason we know, right? Yeah. Now let's solve the main problem. Okay. Are you ready? Yeah. Main problem what we wrote? Sir, TP is equal to PC by 2 into R plus PC1 plus TP1 by into R. Yes. But the second part is all nil, right? So let's write down. 48,000 we already wrote. Divided by 2. Now we will write. Into R we had to know. We know now. Right? 0.091. 0.091. Now because all other things are nil, PC1 plus TP1 0 plus 0 is equal to 0 into something will always be 0. So we'll directly write 0. Okay. So our formula comes to 48,600 divided by 2 into 0.091 plus 0, and our answer will be 2,211. 2,211.